Are you managing private credit at an insurance company? Then this is your event. I'm Stuart Foley, founder and managing partner of insuranceaum.com. Join us in Austin on November 5th and 6th for the Insurers Private Credit Forum. It's all signal, no noise, with solid LP to GP balance, real conversations, and zero sales pressure. You'll meet directly with managers of your choosing and take part in focused educational sessions on investment policy guideline best practices, portfolio construction, and much more. Space is limited. Please head to insuranceaum.com/events and register today. Welcome to another edition of the insuranceaum.com podcast.
You need to control the idiosyncratic risk in your portfolio now more than ever.
Bonds don't always provide protection against inflation.
The best time to be an originator of consumer credit, for instance, is after the market is repriced, after there's been blow up.
The larger the volume, the lower the cost.
The market underwriting right now is actually in a good spot.
My name's Stuart Foley. I'll be your host. Hey, welcome back. It's great to have you. I'm Stuart Foley. This is the insuranceaum.com podcast, where we are the home of the world's smartest money. As a reminder, I just want to make you aware that we do have a Texas private credit ABF event coming up November 5th and 6th in beautiful Austin, Texas at the Thompson Hotel. Insurance investment professionals won't want to miss it because you're going to be talking to other sophisticated investors about the problems and challenges that you face. And you'll also have the opportunity to hear from multiple managers on the same day, which is important given the speed at which things are changing in the capital markets. So just a quick note, you can find it on our website at insuranceaum.com. In the hamburger menu in the upper left, there's an events tab. You can go right there, and it is open to insurance investment allocators only. All right, so the title of the podcast today is a very good one, Beyond the Bank: The Insurance Approach to CRE Loans. Our guest today is David Politano, Managing Director and Head of Debt Strategies for MetLife Investment Management's Real Estate Group. David's been with MetLife since 1994. He has deep expertise across commercial real estate lending, capital markets, and global debt and equity investments. You have a master's in real estate finance from NYU, and you're a graduate of Pace University. David, welcome to the show. We're very happy to have you on.
Stuart, thank you so much for inviting me. My pleasure to be here.
It's great. Let's start with a couple of icebreakers, as we always do. Tell us where you grew up. And the fun question we've been asking lately is, what was your first concert?
Oh, boy. I grew up in Brooklyn, New York. I'm a first-generation American. So I grew up in the Bay Ridge area. And let's see, my first concert would have been a Billy Joel concert in the early 1980s.
Wow, that's a good one. I've mentioned on other podcasts, mine was Billy Squier and Pat Benatar. I didn't care nearly as much about Pat Benatar as I did about Billy Squier. And if memory serves, we sat in the sixth row right in front of the speaker stack, and I got my hearing back about 3 days later. This is like when nobody thought about hearing loss and anything like that. But if you would, tell us a little bit about yourself and some background on MetLife Investment Management, just in case some of our audience isn't familiar.
Sure. Background on myself. Let's see. I started out in banking coming out of school and pretty quickly moved into the real estate group as a restructure guy. So that wasn't something that I wanted to do, but the opportunities were there because of the time when I graduated college in the late 1980s. Worked in banking for 5 or 6 years, and then in 94, took a job with MetLife as a workout guy in their debt space. And it was all commercial mortgages then. MetLife was a mutual company back then. So it was a great way to get into an excellent company. And as you noted in the open, I've been here since 94, so coming up on my 31st year. And been able to grow my career over that time frame to, move on from just doing workouts to originating investments on the mortgage side to the equity side, overseeing our capital markets group and international platform. For the last 3 years, I've been head of the debt strategies group. And, what that means is I'm chairman of their debt investment committee and basically oversee the book of business that we have. In terms of what MetLife Investment Management is, what the transition happened about 12 or 13 years ago, where we moved from just managing MetLife to managing third parties. And today we manage over $100 billion in commercial real estate debt and equity. We've got a team of over 250 people on the ground here in the US, in Europe, Latin America, and Asia. When you look at how we do our business, how many clients we have, we've got onshore clients, offshore clients now, we've got life companies, property casualty companies, pension funds, all of those that we manage money for in the debt and equity space. We've got regional offices. So if you look at MetLife Investment Management, what makes us sort of different than other life companies that are in this space or that have investment management businesses, we've got an on-the-ground approach to real estate, which is the right way to look at it. And since we do both debt and equity in our platform under the same leadership, we look at that as an advantage. So we've got scale and we have operational advantage.
That's terrific. I don't exactly know how to ask this question, but I'm going to give it a try and you see how it goes. How do insurance companies invest differently from CMBS or bank loans? Like, what makes the insurance approach distinct?
It's a great question. In the space that we operate in, MetLife Investment Management originates loans just the way a bank would for securitization or CMBS. The distinct difference is when we originate a loan, we hold that loan, we service that loan throughout its life. So you can call it from cradle to grave. Anyone who does business with us on the borrowing side is dealing with MetLife. In the banking world, when loans are securitized, they originate a loan, they've got to hold it for 30 or 60 days. It then gets wrapped up into a securitization and is sold off as a bond. Investors are buying bonds that are secured by a portfolio of loans. So it's the same underlying product. It's just what happens to the investor. Which investor does it appeal to? And for us, if you were to look at how insurance companies play in the space generally, they're generally more conservative than what you might find in a CMBS. CMBS allows them to buy tranches that are lower risk. When you do business with an insurance company, it's normally that you're buying into a whole loan, one asset. If you were to look at the risk profile of insurance company loans that top out normally in the 60 to 65% leverage area, and you compare that to CMBS, you would say, how do they perform? Well, generally speaking, insurance companies are showing much lower delinquency rates than CMBS. I think just recently there was something published that showed CMBS delinquencies topping up over 11%. And if you were to look at sort of the insurance company book, it's probably around half of that or even less than half of that. So it's a different risk profile. When you do a CMBS deal, if you're a borrower, you're going to be dealing with a special servicer, not the folks that originated your debt. For us, relationship building is really important. That's what our whole business is built on. There are loans in our book today that I originated back in the 1990s that have been back 2 and 3 times for us because of that relationship. CMBS does offer sort of tighter pricing from time to time, but they don't offer the same execution that going with the life company does, specifically MetLife.
I don't want to put words in your mouth, but the resources that you have at MetLife Investment Management are considerable, and it requires those considerable resources to provide cradle-to-grave deployment of capital. Is that fair to say?
Absolutely. And that's what distinguishes us. We originate loans in regional offices. They're serviced or managed in those regional offices. We originate loans in conjunction with our research team telling us where the best opportunities are. All of that makes us different than those that originate for CMBS, at least in my view.
Is it fair? I don't know if this is right or not, but if I'm an investor, is buying that loan in the way that you're describing it, is that going to give me a different yield than if I go with another avenue due to I don't know what the right word is, but it sounds, in my mind, the word is friction. There's less friction.
I agree 100% with that. There's less friction if you're going to go with the life company originator and someone who holds that debt throughout the term, and the investor in it can deal with the life company, or in our case, MetLife Investment Management. I think that's true. This is a fixed income product, Stuart. So it's not so much about what you make, it's about what you keep.
Yeah, absolutely.
And what you keep is usually net of what you lose. And in our space, we've had an excellent track record of exactly sort of what we keep for the insurance company clients that we have. If you were to look back over the period of time from the global financial crisis to like 2024, like the last calendar year that we have, our commercial mortgage book had an average loss of about 4 basis points. If you looked across CMBS and banks, it was probably between 50 and 60 basis points for banks and between 80 and 85 basis points for CMBS.
Yeah.
That's a lot of loss to make up for in a fixed income investment.
Absolutely. Okay, so whenever you're talking about real estate and whatever else, COVID always seems to show up somehow. And so looking back, what was the impact of COVID on property markets from your perspective in debt? I know it requires you to look in the rearview mirror a little bit, but I think it's helpful.
A great question. I would say that since the GFC, we didn't have a sort of anything else that affected real estate debt, real estate equity the way COVID did, the way it affected property markets. The pandemic was a shock to the system. It impacted things in an uneven way, but ones that were predictable when you look back based on how we behaved in a political way. The first to get hit in COVID were hotels and retail. And when you think about it, that's logical, right? You couldn't travel, and you certainly couldn't go in places to shop and be in big groups. So right away, those got hit, and the most modifications we got, the requests came from that space, not the office space. At the same time, we had industrial demand surge. Everyone still had to shop. You were doing that through e-commerce. So when you look at how well e-commerce did, there was the penetration of that e-commerce market grew more than 40% in a single year. And that was something we expected to happen, or our research people expected to happen over a 10-year period, got compressed to 12 months. Office demand in the beginning was unaffected because when you're a tenant in an office building, you have a long-term lease, and it's even though you couldn't go to the office, companies were doing fine and they were paying their rent. That changed dramatically when the world reopened. When the world reopened, retail and hotels did very, very well. So when that happened, if you had loans or you owned equity in those two asset sectors in real estate, sure, you had a little bit of a tough time for a period of time, but right after markets opened, you did fine. Occupancies were back up, people were traveling again, all great. Office did not recover the same way. And there's a lot of talk around what happened there. We kept people out. When I say we, I mean the economy kept people out of office for a prolonged period of time, whether it was school teachers not wanting to go back and teach because there were risks for them to be exposed to COVID or other political reasons. But it was long enough to change people's behavior. And to this day, we still have knock-on effects from that behavior. Most people are now having hybrid work schedules. The amount of people going back to the office has gone up. It's not like you're hearing about people saying we're going to be doing, 100% work from home. That sort of started to turn around over the last couple of years. But the knock-on effect for office has been dramatic.
I appreciate that. The next item up for bids is pricing trends. Where is pricing today versus the peak? And I hate to ask this, but when was the peak? And how are you seeing values adjust across property types? Because we've had other folks on other podcasts who've made the point that people, say, oh, the impact of COVID. But I think where you were headed was aspects of real estate did quite well. It depends on the property type. So can you talk to us about pricing and the values across those various property types?
Sure. So let's handle the first part of your question. When did they peak? When pre-COVID, I would say going into COVID, 2019, very early in 2020, before we knew what COVID was going to do, I'd say that was the peak for all of the asset sectors. Broadly speaking, commercial real estate pricing corrected in the 22-23 timeframe, falling peak to trough between 15 and 20%. Since then, market values have stabilized and they have been increasing slightly. Office remains a problem. I mean, if you were looking at apartments, for instance, over the last year, they're sort of back to where they were in most markets. It's market specific, but most markets where they were around pre-COVID levels. So if you look at office, there are still sort of deep discounts in some markets. Values in the office sector have declined somewhere in the 30 to 35% range. And Stuart, that's broad over the entire US. That does not mean you can't go to markets that have suffered more with the COVID effect than others. So if you were to look at some markets like Seattle, Portland, DC, Chicago, they probably had, on average, broader declines in value. Could be 40%, 50%. And you will see in the real estate publications that occasionally a deal trades for a third of where it was at its peak or its last sale. I would say that right now, according to our research folks, they're thinking that half CBD office markets are seeing positive value growth. This includes some large markets like LA, New York, San Fran, even Chicago, Atlanta, and Dallas. Places like Boston and DC still remain negative. So DC, what's going on in DC? The 800-pound rule in DC is the government. Everybody knows what's going on there. They had pretty liberal policies around COVID, around coming back to the office, not coming back to the office. And you're going to see that DC correction, at least from where I sit, go on for a while. Good news is we think values are sort of at the trough. We think things may bounce around here for the next quarter or two, but it'll be a slow and gradual recovery for the office space.
You use the term CBD. I think that means Central Business District. Is that right?
Correct.
Hey, all right.
Correct.
I got one right. And just one other thing, with regard to office, is it fair to say that, I mean, you mentioned the regional differences. Is it fair to say that the Class A office space did better than some of the other, like, lesser quality office? Is that something that you've noticed, or am I just kind of, I'm out in left field here?
No, you absolutely have it correct. In every market, if you're truly in trophy space, you could make the case today that you're as well off as you were pre-COVID, maybe even a little better in some markets. I don't think it's enough to say that it's just A quality properties. These are literally the top tier buildings, like in New York City, I guess it would be one Vanderbilt, and some of the others in Hudson Yards, you're seeing sort of, those are the best buildings and they're doing really, really well. If you're in some of the B and C quality buildings, it was always expected that those buildings in major CBDs that were older were going to have to go through some sort of adaptive reuse analysis. Because sometimes you can't convert a 1940s, 50s, 60s building into something that people want to be in. What we're seeing is that conversions of those buildings or scraping of those buildings is increasing, which is taking some inventory off of the market. I think Jones Lang published something recently where, for the first time in a long time, you might have had more office space come off the market than go on the market. So more new deliveries. New deliveries were less than space that had been removed from the market. So that's something that will help some of these older sort of B and C properties going forward, with less of it around. Whatever remains will begin to have some traction in the near future.
And just so that, like, I'm on the right page here, when you say deliveries, that's a sale, right?
Sorry, no, it isn't.
It's not.
A delivery means bringing new product to market.
Oh, got it. Okay,
I think, about 7.5 million or 7.6 million square feet, something like that, came on the market as new deliverables, brand new buildings, and about 8 million feet came off the market.
Oh, wow.
So those will be properties that are going to be redeveloped into something else. That was the sort of order of magnitude. It's not a lot, but let's just say that it's not positive growth in the office space
Makes total sense.
over the last year. Just one more thing. I mean, kudos to the municipalities and large cities that are understanding that they have a problem, and they're starting to think about ways to facilitate owners in their quest to convert older buildings to something else. You know, we have a housing crisis in the US, and what a great way to revitalize CBDs if you can introduce some affordable housing, some market rate housing, and that in and of itself would help spur more office use.
Thank you. I want to talk a little bit about the lender landscape in 2025, right? Is it shifting? Who's active? Who's pulling back? And what role are insurers playing in this market?
Great question. I'll start by saying there's still a fair amount of owners who will not transact right now because they believe either rates are too high, there's not enough good news out there for them to go to market and sell properties. And that is mostly in the office space. You're seeing warehouse, industrial, hotels, retail, multifamily, that stuff trading. So you are hearing about this maturity wall, stuff's being pushed forward. So on the one hand, the stuff that's coming to market is good enough where it's going to attract attention from all lenders, banks, insurance companies, investment banks, non-bank lenders like any of the private equity funds that are now in the space. So in terms of having money available, if you have a really good deal, there's a lot of that competition going on right now, and it's driving down spreads aggressively. Even the government-sponsored entities like Fannie and Freddie are in the act doing multifamily at spreads which have compressed at least 40 basis points since the beginning of the year. So if you have good product and you're out in the market to get financing because you don't necessarily want to sell, you just want to finance, or you do want to transact and sell, you won't have a problem finding financing. And it's changed in the last couple of quarters where even good office is trading because there are lenders out there willing to lend on the stuff we were talking about earlier, the best of the best, long-term leases in place in good markets. So it's competitive, still not as many transactions as we would like to see. I think that will change if rates drop. I know today there's going to be an announcement on interest rates, and if that trend continues, I would expect, everyone here would expect the transaction volume to increase. In terms of who's lending the most right now, CMBS has come back aggressively. I think they're on track to maybe hit $100 billion in issuance this year. And that's probably up there over the last 7 or 8 years. That might be back up to sort of their high points, being at the 100 billion plus. So CMBS was definitely active. Life insurance companies, including Met, with the client base we have, we're out in the market. We've got money to put to work. It's more about getting good relative value right now because there are folks who are cutting spread just to put loans on the books.
And just kind of thinking about everything that we've covered on this podcast, is there a trend or an opportunity in CRE debt that stands out to you right now? And whenever I ask a question like this, I always add on, is there anything that is where you're cautious?
It's a great question, and you could probably do a whole podcast just on that.
We'll have to have you back.
We talked about it.
We'll have to have you back.
We were talking about this with our research folks, and we do have a global platform. So we play in markets outside the US. And in terms of what has the best relative value, Mexico industrial right now is a place where we think you can get premium. They've done fairly well in the negotiations with the US. Trump 1.0, Trump 2.0, they seem to be doing pretty well. And Mexico, in their space, warehouse spaces, a lot of stuff gets manufactured there. So that's the key space that we like to play in there for our clients. I would say that we've been playing there for over 20 years. The book is solid. You get paid in dollars. The rent is paid in dollars. These are dollar-denominated loans. So given that we have access to that market, we think it's a great opportunity going forward. In terms of where to be cautious, there are green shoots in the office space. If you pick your spots like some lenders are doing today and you're playing in the best of the best, I think you're going to do just fine. You're getting paid for it. The risk adjusted return seems very reasonable. I would still be very cautious about markets that are still suffering from either something politically where they're, just now places, certain markets, the political atmosphere around them, making cities safer, improving quality of life, taking a different view towards quality of life crimes, that kind of stuff. If that continues to play out, that's great. In a year from now, we can talk about other markets that would be good places to put money. I'd be cautious about certain office markets that have those attributes.
That's super helpful. If you could give us a talking point or two, or a wrap-up point or two, what would it be for our audience? And then I got a couple fun ones for you on the way out the door.
I think that real estate looking forward, we've come through some pretty tough times over the last 3 or 4 years. This is probably, I've been in the real estate business since the late 1980s. I've seen a lot of different cycles throughout that. This has been the most challenging. I think that going forward, the worst of it is behind us. Assuming that we don't slip into some sort of terrible recession, I think that things will look much better a year from now than they do today in that space, in the real estate space.
Really helpful. Great education. Really appreciate you being on. Whenever somebody is with a company for a long time, and MetLife Investment Management has others that have been with your firm for a long time, which I think is something you can't make that one up. There's nothing you can do about that one. So the question I guess I have is, and it speaks to the culture there, right? What characteristics are you looking for when you're adding members to your team?
It's a great question, and I have a simple answer for it. When we add people to our team, they have to be, team dynamics are critical. So they have to be willing to work in a team environment. No one here, and I think this is true of any business, any sport, there really no sort of lone wolves that are successful. It's being part of a team, being willing to listen to what other people's opinions are, being united in what your purpose is, how you're going to grow. All of that's really, really important. I've had over 30 years of MetLife, mentored many folks, many of the folks who worked with me when they were very junior and now are senior people. And if their level of engagement and their willingness to learn is at a certain level, and they pursue what they're doing with professionalism and purpose, we can teach you the rest. If you're at that early stage in your career, you're out of school 4 or 5 years, if you have that and you love what you're doing, you like the people you work with, you're going to be successful. So we look for people like that. And I surround myself with really good managers. I've had the great fortune of working with some fantastic people. That's what it's all about.
That's terrific. All right, last question. You can have dinner with up to 3 people. Can be 1, 2, or 3. They can be alive or dead. David, who's going to dinner with you?
Oh my. Jeff Weinroth, who arranged this, told me that you might ask that question. And of all the things that we talked about, this is the most difficult one. So I'm gonna break. Is this one dinner, or are we doing 3 separate ones?
No, it would be. I mean, the way that we set it up is it's one, but hey, I mean, it's a hypothetical, so you can change. You can change.
Okay.
You can change the situation
so
here.
I'm gonna give you three different folks. It's gonna cover science, sports, and investments.
I love it.
So in the science world, there's probably a long list there. It's something I'm very interested in. I think Jonas Salk would be pretty good to have it at a dinner. He's gone now, but he would be great to have at a dinner, right? When you look at impact of the polio vaccine, he'd be number one. Sports was really tough. I want to have a sports person there. Huge basketball fan. Growing up, in the 1980s, I would have to say it's between Magic Johnson and Larry Bird. I might probably lean more towards Bird because I'm a Northeast guy. So I think Jonas Salk, Larry Bird. And then for investments, just because it's where I've spent my career, 2 names sort of pop out. I'd say either Warren Buffett for sure and Peter Lynch. I might lean more towards Peter Lynch than Warren Buffett, just because I don't know how we'd have a conversation with Warren Buffett. So I think Peter Lynch probably would be the guy.
I was fortunate enough to work for a company owned by Buffett, and I got a chance to be in a lunch where he was speaking for an extended period of time twice. And he is a really, really good investor, but I don't think that he does anything that's particularly like whiz bang. He has a set of principles and he invests those principles, but he has so much knowledge about other things. He's just a really interesting guy. So that he's definitely the leader in the clubhouse as far as people who want to have him. So really appreciate you coming on. Great podcast. And thanks so much for taking the time.
Absolutely. It's my pleasure, Stuart.
The title of the podcast has been Beyond the Bank, the insurance approach to CRE loans. Our guest has been David Politano, Managing Director, Head of Debt Strategies for MetLife Investment Management's Real Estate Group. If you like what we're doing, please rate us, review us on Apple Podcasts, Spotify, Amazon, or on our brand new YouTube channel at Insurance AUM Community. If you have ideas for podcasts, please shoot me a note at Stuart@insuranceaum.com. We are the home of the world's smartest money at the insuranceaum.com podcast.